Pay very close attention to this. What's happening in the silver market right now is not a normal rally, and it's not driven by retail traders or headlines you're seeing on financial TV. This is a strategic shift, and most Western investors are watching the wrong signals. If you own silver, if you've avoided it because it feels too volatile, or if you think you already missed the move, the next few minutes could completely change how you see this market. Because while everyone is focused on interest rates, inflation data, and trade war noise, China has been quietly executing a long-term silver strategy, and silver sits right at the center of it. This isn't panic buying. It isn't speculation. It's methodical accumulation by a country that plans in decades, not quarters. And when a nation with China's manufacturing power starts securing a critical industrial metal, it's never accidental. Here's the part most investors are missing. Silver isn't just money, it's infrastructure, it's energy, it's technology. And when supply chains tighten, the countries that control the metal control the outcome. By the end of this video, you'll understand why recent price spikes, margin hikes, and China's positioning aren't separate events, they're connected. And why the path toward triple-digit silver isn't hype, but a structural setup most of the market hasn't priced in yet. Here's what nobody's connecting. While headlines scream about tariffs and trade wars, China has been quietly repositioning itself in the precious metals market. And silver sits at the absolute center of that strategy. Look at the pattern. Chinese imports of silver have been climbing steadily, not sporadically. This isn't panic buying, this isn't speculation. This is methodical accumulation by a nation that thinks in decades, not quarters. They're not buying silver to flip it next month. They're buying it because they see what's coming. Why does this matter? Because when a country with China's manufacturing base, with their electronics production, with their solar panel dominance starts stockpiling the key ingredient, it sends a signal. They're either preparing for supply disruption or they're planning to control pricing power. Maybe both. And here's the part that should make you uncomfortable. China produces nearly a third of the world's silver. They consume even more. That positioning gives them leverage that most investors completely underestimate. They can squeeze supply. They can dictate terms. They can essentially create a choke point in the global market whenever they decide the timing is right. Think about the implications. If China decides to restrict exports, even slightly, the Western market doesn't have easy alternatives. You can't just flip a switch and start mining more silver. Projects take 5 to 7 years to develop. By the time new supply comes online, the game's already over. Now let's talk about what happened in late 2024 and early 2025. Silver didn't just rally, it exploded. And when it hit the low 80s, something critical happened. The exchanges panicked. Margin requirements got hiked, not once, multiple times. In some cases, traders saw their capital requirements double in a matter of weeks. That's not normal market behavior. That's the system hitting the emergency brake because volatility was threatening to break the machine. Here's what most people don't understand about margin hikes. They're not bearish for the underlying asset. They're bearish for leveraged speculators. There's a massive difference. When margin requirements jump from $12,000 to $25,000 per contract, it doesn't change the fundamental value of silver. It changes who can afford to play the game. Small speculators get forced out. Weak hands capitulate. Momentum traders who were riding the wave suddenly can't meet the new requirements. That forced selling creates the violent corrections we saw. But here's the critical part. Once the leverage gets flushed out, once the system resets, the move can continue with a much healthier foundation. Because now you're left with real buyers. Physical demand, strategic positioning, not just speculators chasing a chart. And if you look at what happened after those margin hikes, silver didn't collapse back to 40 or 50. It held above 70. That's the tell. That's the market showing you that the fundamental bid is real. For decades, silver had a ceiling. That ceiling was $50. Every rally died there. Every breakout failed there. It was psychological bedrock in this market until it wasn't. When silver blew through 50 and kept running, something fundamental shifted. It's not just about the price. It's about the mentality. Once a market proves it can break a multi-decade barrier and hold above it, you can't use the old playbook anymore. Traders who keep waiting for silver to return to normal are fighting the last war. The market has already told you normal doesn't exist anymore. The question isn't whether we go back under 50. The question is, where does the next resistance show up? And here's where the math gets interesting. If 70 becomes the new floor, if that's the level where buyers consistently show up, then the next psychological barrier isn't 80. It's not 90, it's $100. Why 100? Because round numbers matter in human psychology. They matter in headlines. They matter in narrative. And when silver approaches triple digits, it won't just be metal traders paying attention. It'll be mainstream investors, wealth managers, financial media. That's when the second wave of capital arrives. Let's shift to something that's not getting nearly enough attention. Silver demand from industrial applications is about to accelerate in ways that most supply forecasts haven't accounted for. Solar panels are the obvious one. But it's not just about the panels being built now, it's about replacement cycles. Solar installations from the 2010s are going to need upgrading. That's a fresh wave of silver demand that's baked into the next decade. Then there's electric vehicles, not the batteries, the charging infrastructure. Every fast charger, every power converter, every electrical system upgrade requires silver, and we're talking about building out millions of charging stations globally. 5G and 6G infrastructure, data centers, AI computing facilities that require massive power management systems, medical devices, water purification technology for developing nations. The list keeps growing. And here's the kicker. All of these applications require physical delivery. You can't build a solar panel with a paper futures contract. You can't wire a charging station with a synthetic ETF. The industrial users need actual metal. And when industrial users compete with investors for limited supply, prices don't stay flat. Now let's talk about the supply side. And this is where things get uncomfortable for anyone who thinks silver can't sustain higher prices. Silver mining hasn't kept pace with demand for years. The deficit has been filled by above-ground stockpiles, recycling, and optimistic forecasting. But those sources are finite. Above-ground inventories have been drawn down. Recycling has limits because once silver goes into a solar panel or circuit board, recovery is expensive and often not economically viable. And the optimistic forecasts, they assume new projects come online on schedule. They never do. Let me give you a concrete example. When a copper mine shuts down because copper prices fall, silver supply contracts too, because most silver comes as a byproduct of copper, zinc, and lead mining. So silver supply is held hostage to the economics of completely different metals. Right now, copper is facing its own supply challenges. Grades are declining, ore quality is dropping, energy costs are rising. That means even if silver prices hit $100, you can't just produce more silver by willing it into existence. The lag time is brutal. Even if a mining company decided today to fast-track a new silver project, you're looking at minimum 5 years before first production. Permitting alone can take 2 to 3 years, then construction, then ramp up. By the time that metal hits the market, the supply crisis has already played out. Here's where everything connects. China doesn't just buy silver. They dominate the downstream processing. They control the refineries. They manufacture the solar panels, the electronics, the industrial components that consume silver. That vertical integration gives them power that Western investors consistently underestimate. If China decides to prioritize domestic use over exports of finished goods, they're essentially locking in their silver supply while Western nations scramble. And there's a geopolitical angle here that's impossible to ignore. In a world where supply chains are fracturing, where nations are prioritizing strategic resources, silver isn't just a commodity. It's infrastructure, it's technology, it's national security. When the United States talks about reshoring manufacturing, when Europe talks about energy independence, they're talking about industries that require massive amounts of silver, but the supply chains are in China. The processing capacity is in China. The expertise is in China. You can't just rebuild that overnight. And until you do, you're a price taker, not a price maker. Here's something that should terrify anyone who's short silver. The futures market is starting to show signs of stress, not collapse. Stress. And stress is the warning sign before things break. Delivery requests have been rising, not astronomical yet, but trending in a direction that matters. When futures traders start asking for physical delivery instead of rolling contracts, it means they don't trust the paper game anymore. Spreads between physical and paper prices have been widening. That's the market telling you that contracts and metal are starting to decouple. And when that decoupling accelerates, the people holding paper promises get nervous. Now, the exchange can hike margins. They can change rules. They can slow things down. But they can't create physical silver out of thin air. And if delivery pressure keeps building, if industrial users start demanding metal, if investors lose faith in synthetic exposure, the squeeze gets real. We saw a preview of this in late 2024. When silver spiked into the 80s, the machinery started making scary noises. Margin hikes were the release valve. But release valves have limits. At some point, the pressure is too great and the system has to reprice. Now let's talk about where the real opportunity might be. Silver miners have lagged dramatically while silver makes historic moves. Why does that matter? Because it means the easy money hasn't been made yet. When miners lag the metal, it typically means the market hasn't figured out the trade yet. Here's the math. A silver miner with production costs at $18 per ounce was profitable at $30. At $70, they're printing cash. At $100, they're minting money. Those profits flow to free cash flow, dividends, share buybacks. The operating leverage is exponential. When earnings reports show margins that were unthinkable 2 years ago, that's when the catch-up trade happens. And catch-up trades in mining stocks are violent. So let's map out what $100 silver looks like. Not as a guarantee, not as a prediction, as a scenario analysis. First, China continues strategic accumulation. They don't need to announce it. They just keep buying methodically through state-connected entities that remove supply from the market quietly. Second, industrial demand stays firm. Solar build-out continues. EV infrastructure expands. 5G networks roll out. The physical bid doesn't go away. Third, one of two macro scenarios plays out. Either inflation stays stickier than expected, pushing investors toward real assets, or growth weakens while inflation persists, creating the stagflation nightmare where hard assets outperform. Fourth, mining supply disappoints. Projects get delayed, grades decline, byproduct supply from copper and zinc contracts. The deficit widens. Fifth, the futures market faces a credibility crisis. More delivery requests, wider spreads, growing skepticism about paper exposure. Investors rotate toward physical or miners. If even 3 of those 5 factors align, $100 silver isn't far-fetched. It's arithmetic. Let's circle back to those margin hikes because there's a deeper message most people miss. When exchanges hike margins aggressively, they're not saying the rally is over. They're saying the rally is too fast for the current infrastructure to handle. That's completely different. If silver was topping, if demand was evaporating, if the move was finished, margins wouldn't matter. The price would collapse on its own. You don't need to hike margins on a dead trade. But when you're hiking margins multiple times, when you're doubling capital requirements, when you're effectively restricting access, you're admitting something. You're admitting the underlying pressure is real. You're admitting that volatility reflects genuine imbalance, not speculation. And here's the tell. After the margin hikes flushed out weak hands, after the leveraged players got forced to exit, silver held its ground. It didn't crater. It didn't break. It consolidated. That's not what a bubble does. Bubbles pop. They don't consolidate at elevated levels after forced selling. They collapse. Here's what separates successful commodity investors from everyone else. They don't chase. They don't panic. They understand volatility is the price you pay for asymmetric returns. Right now, most investors are uncomfortable. That discomfort is exactly what creates opportunity. When everyone's comfortable, that's when you're late. When the trade feels dangerous, when skepticism is high, that's when you're early. The margin bombs scared people. The China angle confuses people. The $100 target sounds crazy. That means the crowd hasn't bought in yet. So what are the signposts? What tells us this thesis is playing out versus falling apart? Watch Chinese import data. If their silver imports stay elevated or accelerate, that's confirmation. Watch physical premiums. If the spread between spot and physical stays wide or widens further, that's stress in the system. Watch mining stock performance. If miners start catching up to metal prices, that's the rotation happening. Watch delivery data from futures exchanges. If requests keep rising, that's pressure building. Watch industrial user behavior. If manufacturers start securing long-term supply contracts, they're worried about availability. And watch the macro backdrop. If inflation stays problematic, if currency confidence weakens, if geopolitical tensions escalate, all of those support hard assets. Let me be direct. This thesis falls apart if China reverses and dumps silver, if industrial demand craters in recession, or if new supply arrives faster than expected. If the Federal Reserve crashes commodity prices across the board, silver won't be immune. If margin requirements kill all speculative interest, liquidity dries up. But which scenario is more likely? China dumping resources they've been accumulating or continuing, industrial demand cratering when green energy is global policy priority, or growing? New supply magically appearing when projects take 5 to 7 years, or deficits persisting? You assess probabilities, you manage risk, but don't let fear of being wrong prevent you from seeing what's happening. So here's where we are. Silver broke out of a multi-decade range. It survived margin bombs. It's holding above levels that were resistance for 40 years. China's accumulating, supply's tight. Industrial demand's growing. Miners are cheap. That's not a guarantee of $100 silver, but it's a setup where the risk-reward is skewed in a very specific direction. The question isn't whether silver will definitely hit 100. The question is whether the probability is being priced in right now. And if it's not, what's the opportunity cost of missing it? The expensive mistake isn't buying something that goes sideways. It's missing something that goes vertical because you were waiting for perfect certainty. Perfect certainty arrives at the top. The opportunity is now in the uncertainty, in the volatility, when most people are still debating whether it's real. China's playing chess while everyone else argues. The margin bombs proved underlying strength. The path to 100 isn't guaranteed, but it's mapped. The only question is whether you're positioned when the next leg starts.